They said war would shatter the world of digital assets. They warned that escalating conflict in the Middle East could send Bitcoin tumbling into oblivion. Yet here we are, and Bitcoin remains as resolute as ever. That's right. Despite the dramatic tensions between Israel and Iran, despite missile strikes and roaring fires at crucial energy facilities, the world's most famous cryptocurrency has barely flinched. So what's going on under the surface? And how could this single event become a turning point in how we view Bitcoin's place in the global financial puzzle? In this episode, we'll unravel the hidden threads connecting war, oil shocks, and the mysterious power of monetary liquidity. So, stay with us. What's the real story behind Bitcoin's apparent indifference to geopolitical chaos? We're going to break it all down, from the sizzling events at the South Pars gas field in Iran, to oil prices that have skyrocketed in the face of uncertainty, to a surprising predictor that points away from headlines and toward a deeper force shaping Bitcoin's fate. You heard that right. Beyond hype and fear, there's a powerful undercurrent that some experts believe truly steers the Bitcoin ship. We'll explore just how and why this might revolutionize your understanding of cryptocurrency markets. In today's journey, we'll look at the numbers, the theories, and the compelling data behind Bitcoin's moves. We will analyze how the global M2 money supply plays a starring role in setting Bitcoin's price direction. We'll see why conflicts on the geopolitical stage may not matter as much as we think, and why that fact alone might hold one of the biggest clues to the future of money. Ready to see how it all fits together? Let's dive straight in. Now, picture the scene. A region already simmering with tension erupts as Israel reportedly strikes Iranian energy facilities, targeting crucial production hubs. Flames flicker at the South Pars gas field, immediately conjuring nightmares of supply disruption and a storm in the international oil markets. As expected, the price of oil responds with a dramatic leap, climbing more than 7% in record time. Industry watchers, like those following analyses in the Kobeissi letter, brace themselves for impact in the trading week ahead. After all, from the vantage point of traditional finance, supply shocks and heightened tensions often translate into market upheaval. But here's the kicker. While oil took off, Bitcoin's price scarcely stirred. Where many expected a big sell-off, or at least some kind of dramatic move, we got little more than a ripple. A feeble 0.02% increase, basically a rounding error, was all the price could muster, making it appear eerily calm in a chaotic world. Sudden question, how is that even possible? We've all heard how geopolitics can upend stock markets, rattle currencies, and raise alarm bells for major commodities. Why not Bitcoin? Enter macro investor Raoul Pal. His surprising claim is that Bitcoin's real dance partner isn't lurking on the world stage of political might. Instead, it's in the domain of economics, namely the global M2 money supply. Based on Pal's charts, which track Bitcoin's price movements alongside fluctuations in money supply, the relationship is super tight. He cites an 89% correlation, which is staggering in financial analysis terms. That suggests that if you want to know where Bitcoin is headed, you might want to look less at the news headlines around wars or elections, and more at the big picture of how much money is floating around in the system. This concept is called following the liquidity. When central banks around the world are loosening monetary policy, lowering interest rates, and making money more abundant, investors have fresh capital to put toward riskier assets, including Bitcoin. But in times when liquidity dries up, even the most promising investments can suffer. Admittedly, it's not a fully accepted dogma. Some argue that the crypto markets are too young, too volatile, and too influenced by news hype for macro liquidity to matter so much. But Pal's data suggests otherwise. He sees a straightforward trend. Wherever M2 money supply goes, Bitcoin follows sooner or later. That's a big departure from mainstream thinking. Of course, we can't ignore how deeply ingrained the idea is that geopolitical risk often sends shocks rippling through all sorts of markets. When a conflict breaks out or intensifies, conventional wisdom says that investors will flee to safety, potentially dropping risky assets like Bitcoin in favor of time-honored havens. But in these last events, tensions in the Middle East and the direct threat to major energy hubs, that old formula somehow failed to hold. We found ourselves in a realm where Bitcoin simply resisted drama. That's the story we're telling, a narrative of how a digitally scarce asset, free from centralized control, stayed strong under the shadow of a potential new war front. The same pattern emerges when looking at other big news items in recent history. elections, supply chain crises, even policy announcements from government leaders. While these often rattle equity, bond, and commodity markets, Bitcoin has at times marched to its own beat. That begs a pressing question. Are we witnessing a real turning point where Bitcoin's correlation with stocks, oil, or other traditionally sensitive assets is losing strength in favor of monetary liquidity signals? If you find that question intriguing, hit that like button below to let us know. Your thumbs up helps this channel keep bringing you deep dives into market mysteries just like this one, and we're only getting started, so stay tuned. Now, to deepen the mystery even further, let's talk about what happened after the strike on Iranian territory. While the oil markets braced for immediate disruptions to shipping routes and logistical nightmares, financial analytics companies like Alva started recording data on how these events might cascade. They quickly noted that oil futures had shot up more than 7% in response, and that was only the initial jump. Many watchers speculated that further upward pressure was looming, especially if tensions escalated and production became even more uncertain. Market observers might have assumed that Bitcoin, ever so often labeled digital gold, would act as either a safe haven or a high-risk asset in the face of this tension. Instead, it offered a big, collective shrug. This speaks volumes about the role that liquidity, and not necessarily conflict, plays in driving its price. It's almost as if world-spanning headlines and potential flashpoints simply do not matter in the short term if the spigot that pours money into or out of markets is not turned in either direction. What does this mean for everyday investors in cryptocurrency? On the face of it, it suggests a radical shift in perspective. Rather than treating Bitcoin as a commodity whose fortunes are swayed by news bulletins and conflict narratives, serious investors might want to focus on interpreting signals of monetary expansion and contraction. When there is more money floating around, when central banks engage in quantitative easing or lower interest rates, Bitcoin may rally. When the money supply contracts, watch out, because even the mightiest digital asset might bend under the weight of restricted liquidity. Now, is this principle bulletproof? Certainly, many factors go into asset prices, including investor psychology, technology developments, regulatory shifts, and big announcements from corporate giants. But it does raise questions about how we, as a market-watching public, interpret big, splashy news events, and how we might need to sharpen our skills at reading liquidity indicators instead. But let's not get ahead of ourselves. One might still want to keep track of major world events, because sometimes the threat to supply lines or confidence is so big that it bleeds into the broader economy, impacting money flows. For instance, a major international crisis could alter central bank policies, eventually tightening or loosening money supply. Yet, as long as such events remain local or contained, and central banks take them in stride, Bitcoin might well sail on, ignoring the swirl of daily headlines. Let's bring back Raoul Pal's chart. In it, we see the M2 money supply curve spanning the last 3 years. Mirroring that line with Bitcoin's trajectory reveals a startling parallel dance. Each time governments around the world pumped liquidity into the system, be it for pandemic relief or economic stimulus packages, Bitcoin soared. Conversely, each time the spigot narrowed, Bitcoin's ascent slowed or even reversed. Over a lengthy period, that pattern smashes the notion that daily news triggers are what truly move the needle. Instead, it is literally the ebb and flow of global finance measured in trillions of dollars that appears to drive Bitcoin's fate. We can't help but compare that to more conventional markets. Oil, for example, often does respond directly to geopolitical rumblings because disruptions in physical supply and shipping have immediate real-world consequences. But Bitcoin is different. It has no direct reliance on shipping lanes or physical materials. It's anchored in a virtual realm of blockchain protocols, so physical supply disruptions don't matter to it in the same way. That's not to say Bitcoin is immune to fear. Panic can drive even the boldest traders out of a risky position. However, the data around these events in Israel and Iran suggests that fear was not widespread among Bitcoin holders. Or, if it was overshadowed by the overarching liquidity environment, meaning there just wasn't the impetus to dump Bitcoin or to pour into it. The price, accordingly, moved little. If you find these revelations helpful or surprising, we invite you to subscribe and turn on notifications so you never miss our next deep dive. Our channel thrives on your curiosity, and by subscribing, you'll be the first to catch intriguing explorations, not only of Bitcoin's resilience, but also potential future game changers in the financial world. Welcome aboard. Let's step back into the storyline of how these tensions have shaped not just the price of oil, but also investor psychology. For many, the warlike posture of nations is a stark reminder that black swan events can crop up at any time, hitting portfolios hard if you're unprepared. In the past, people saw Bitcoin's unpredictability as a reason to label it a high-risk bet, an asset that might crater the instant real chaos struck. Yet, ironically, this instance has shown that it might be less sensitive to war headlines than the old logic would have suggested. Some analysts try to label this phenomenon as the decoupling of Bitcoin from the standard fear and greed cycles that accompany widespread turmoil. The difference, they claim, is that Bitcoin, although still volatile, responds more directly to macroeconomic levers, especially interest rates, quantitative easing, and broader liquidity expansions. This is significant because it positions Bitcoin within a domain typically reserved for advanced macro instruments, where large funds and institutional players pay close attention to what central banks do. Think about how far we've come from the days when Bitcoin was regarded as the currency of anonymous internet transactions. Now, giant financial institutions track its every move, and leading macro investors use sophisticated models to predict when it will rise or fall. That also means that if Raoul Pal is correct, Bitcoin holders, large or small, should watch central bank policy far more closely than Middle East tensions if they want to predict the coin's performance. It's a new world where your nightly news might not shape your crypto strategy, but the Federal Reserve or European Central Bank announcements definitely could. We can't ignore, however, that war can bring about chaos in monetary policy too. If tensions spike oil prices high enough, inflation can creep in, forcing central banks to make tough decisions. They might raise interest rates to curb inflation, or they might implement measures to soothe markets. Either way, such adjustments ripple into the liquidity conditions that, as we've learned, are vital to Bitcoin's vitality. So, if the geopolitical situation evolves into something that actually shifts the flow of money worldwide, it may eventually show up in Bitcoin's price. At this point, you might be wondering, does that mean we can safely ignore the news altogether and just keep track of liquidity? That might be too strong a leap, but it does mean you can weigh events by how much they're likely to alter investment flows. That's especially true if you're setting a Bitcoin strategy, whether it's short-term or long-term. Instead of responding to every alarming headline, you could watch for signals of policy changes or disruptions in how money is circulated. That might give you a more systematic approach to decisions about holding or selling your Bitcoin. This perspective also shines a light on why Bitcoin has shown resilience in periods of political or even economic uncertainty. Remember the series of global events, from trade tensions between major world powers to fears of recessions, that have come and gone, with Bitcoin frequently forging ahead. Many observers found it puzzling that a risky asset could remain buoyant, or that it might even surge during times of tension. But if its fate was always tightly bound to liquidity expansions, then maybe it isn't so puzzling after all. Now, to see how this dynamic might unfold in the near future, consider how governments might respond if the tensions ignite further in regions critical to energy supplies. We could see an inflation spike from climbing oil and gas prices, which central banks might combat by tightening monetary policy. That, ironically, could stifle Bitcoin's growth if the liquidity spigot closes. On the other hand, if central banks decide not to clamp down, letting inflation run due to concerns of harming the broader economy, more money might circulate, even inadvertently fueling further appetite for Bitcoin. Thus, ironically, conflict can have a roundabout influence on Bitcoin's fortunes, but mostly through changes in monetary policy, not direct market panic. And that brings us full circle to the heart of what we're discussing, the hidden labyrinth of Bitcoin's correlation with M2 money supply. This perspective stands in sharp contrast to mainstream analysis, which sifts through daily events to gauge the cryptocurrency's direction. If the M2 money supply correlation remains this robust, it might mark a turning point where novices and pros alike realize that scanning central bank announcements is more critical than staying glued to the nightly news for Bitcoin-related developments. It's a narrative that challenges the old assumption that fear and speculation drive everything in crypto. Instead, it repositions digital currencies within the broader tapestry of global finance, where liquidity is king, and events like war, while tragic and impactful for commodities, are less central than we once believed, unless they seep into the monetary bloodstream. Should we trust the data? That's a question each investor must answer for themselves. But evidence is piling up, and more voices are joining Raoul Pal in the chorus. Many are discovering their own chart patterns that link Bitcoin's price to macroeconomic indicators. Some argue that we need a longer timeline to be certain, or that the correlation might be somewhat coincidental. But it's hard to argue with an 89% figure that's held up over 3 years of significant global turmoil, including a global health crisis and repeated tensions in strategic regions. The bigger picture might be that Bitcoin, once misunderstood as merely a speculative toy, is evolving into something that global headlines can't easily budge. In such an environment, even dramatic events like strikes on energy facilities make fewer waves in the crypto sea. Perhaps the narrative here is not just about ignoring war news, but about realizing that Bitcoin is driven by deeper ocean currents, in the form of macro liquidity rather than the storms on the surface. To many, that is a reassuring sign. It means that, as a Bitcoin holder, you can stop losing sleep over every rumor of conflict or political dispute. Instead, you might want to focus on big steps taken by the leading central banks, or watch for global liquidity expansions and contractions. The real triggers for Bitcoin's next surge, or slump, may lie there. That begs the question, how quickly will mainstream acceptance of this principle spread? If the pattern endures, we might see more asset managers reclassifying Bitcoin from a high volatility outlier into a macro-driven digital asset. We might also see them using new strategies, factoring in potential liquidity shifts before making large-scale trades in Bitcoin. If so, that could anchor Bitcoin in a new segment of the financial world, far removed from the days of magical internet money. It would become one more piece of the wide, ever-shifting jigsaw puzzle of global markets, guided by liquidity first and foremost. For the individual sitting at home, enthralled by the promise of cryptocurrencies, that realization can be a game changer. It spares you from constant fear of the next shocking headline, urging you instead to glean knowledge from macroeconomic signals. Studying the Federal Reserve statements, the European Central Bank's policy shifts, or the People's Bank of China's monetary maneuvers might give you a stronger grasp of Bitcoin's future path. And ironically, that might mean that, in certain scenarios, Bitcoin becomes somewhat more predictable than the hype cycle or the doom and gloom headlines would suggest. Finally, the concept of ignoring daily headlines in favor of liquidity data also helps to explain Bitcoin's performance during other global crises, be it trade disputes or notable elections. Where traditional logic says risk assets should quake in the face of conflict or uncertainty, Bitcoin's greater correlation with liquidity suggests it may ignore the noise unless that noise reverberates into central banks' decisions. And there you have it, a multi-layered look at how biblical-sounding conflicts in the Middle East scarcely moved Bitcoin's price, how oil soared while crypto steadied, and why the real puppeteer may well be the invisible hand of macro liquidity rather than the TV or social media headlines. It's a provocative narrative, one that might just upend how you think about investing in cryptocurrencies. The next time someone warns you that Bitcoin is bound to collapse due to tomorrow's confrontation on the geopolitical stage, you might remember Raoul Pal's chart and that telling 89% correlation. With that perspective firmly in mind, we thank you for joining us on this deep dive into Bitcoin's surprising resilience. May it serve you well in your next moves, whether you're a seasoned trader or just starting your journey with digital assets. Keep the conversation going. Share your thoughts on Bitcoin and global liquidity in the comments section. Does this new paradigm shift your strategy or simply confirm your suspicions? And that's a wrap for our breakdown of why this cryptocurrency might just shrug off even the gravest headlines in favor of that subtle flow of global money supply. Until next time, stay curious, question the status quo, and keep your eyes on liquidity. Bitcoin's path might just lie there, hidden in plain sight.